Good afternoon, I'm Martin Taggart, this is Adam Grimsman, and we're here to talk about money.
Absolutely.
So we got to be really serious when we talk about money.
Absolutely.
So interest rates have done some interesting dances.
Yeah.
So where are we kind of ish on the relationship between 30-year and 15-year rates?
Yeah, so over the last couple of months, we have seen a jump in interest rates. So from a historical standpoint, they're still very, very low, but they're not at the bottom of the barrel like what everybody was used to hearing about in the last 6 to 8 months. Everything is saying rates in the twos, rates in the twos. They're still there on a 15-year fix, but on a 30-year, they've crept up into the 3%, anywhere from 3 to 3.25. So still lower threes, still phenomenal rate on a 30-year. But the days of the bottom market rates are definitely behind us.
So all other things being equal, if somebody shows up and they're carrying a 60-day-old pre-approval letter that said that they could buy a $350,000 home at 2.5%, isn't it about time they come back and talk to you a little bit about, okay, if you're moving forward, if you're making a decision to move forward, let's talk about how interest rates affect what you can buy?
Yeah, so obviously as interest rates go up, the buying power goes down. So if you are already towards the max of your pre-approval amount and you're looking at homes towards that max, it's really time to talk to your loan officer to see what that new pre-approval amount might be.
Okay, interest rate's not the only thing that goes into the mix because you've also got other factors. So how does, let's say, how does improving your credit score right now or paying down debt or improving your debt to income ratio, how does that work in conjunction with the rest of the pre-approval process to get you the best rate?
Yeah, so what goes into the rate? If you're not putting 20% down, which we see a lot of buyers not putting 20% down, especially in this market. Whenever you're looking at a conventional loan, your private mortgage insurance is tiered off your credit score and the amount that you put down. So the higher that credit score is, the lower that mortgage insurance is, which is in return giving you back that buying power that you might have lost once the interest rate went up.
So let's transition here for just 1 second. Now, our president has decided that he's asking mortgage companies across the country to consider moving to a 50-year note. So what do you think about that?
Personal opinion, I think it's a little bit too long. So I mean, that note is out there for a little bit too long. Prior to 07, 08 crash, we did see 40-year mortgages. In terms of different interest rates, I don't know what an interest rate on a 50-year mortgage would look like. That amount of money being spread out that amount of time, you're probably picking up a lot more in interest that you pay over the life of the loan, and therefore it might not be advantageous to the average consumer.
Something else to think of, if you're a consumer who's saying, man, go 50-year, go, because I'm going to end up with a lower payment, think about what Adam just told you. Interest rates on that 50-year loan are likely going to be a little bit deeper. They're going to be higher, right? So you may not actually pick up that much money on a monthly payment to your advantage. Also, think of it this way. If we're selling homes now on 30-year and 15-year notes, that same $350,000 home on a 50-year note is likely to be sold at $400,000. Does that make sense?
Yeah, absolutely.
So it's going to force home prices up, and consumers are going to be the losers because they're going to pay more interest over the value of the loan.
Yeah, they are. I mean, you're taking out a sizable amount of money, and you're just paying interest on that. And on a case of a 50 compared to a 30, you're paying interest for 20 years longer on a substantially large amount of money.
I wonder how too that would affect passing real estate from, say, you and your wife down to another generation or as a gift to somebody, because the chances of you paying it off have got to be less than zero. I mean,
yeah, whenever a house changes hands, whether it goes from family member to family member, after 50 years, not the average person lives in a house for 50 years. So you're pretty much guaranteed anytime real estate changes hands, whether you are passing it to a family member, that note isn't going to be free and clear, and there's got to be a debt that's got to be cleared up before that transaction can take place.
So what other kinds of things right now are affecting how much money costs or the financial side of buying a home?
Yeah, so the one thing that we're seeing right now is obviously what caused these interest rates to dip was COVID, and the grip that COVID had on us was driving those interest rates down. Now that things are opening back up and it's having less of a hold and people are returning back to normal, it's creating more optimism in the market, which is actually creating interest rates to rise. So that's the biggest thing right now. We've heard it for the last year, COVID. In terms of what it's doing to interest rates, it hasn't gone away. by any stretch of the imagination.
So now think about this. Optimism in the market is creating opportunity for interest rates to go up. I wonder if everybody understands how that works.
Yeah, it sounds backwards. You would think more optimism means better things for interest rates. That's not necessarily true. So there's a whole wide of other things that are going to impact that interest rate.
So one of the things that Adam's talking about is the big announcement that the Fed made yesterday. And before he talks about that, just understand there's a pretty healthy disconnect between the Fed rate and a mortgage interest rate. As a matter of fact, they're almost not connected because the Fed rate is not the barometer that the mortgage interest rate is connected to. That's typically a 10-year or 20-year treasury. But what did the Fed announce yesterday that was a big deal for us?
So the big thing that was announced yesterday is when that Fed came together, it was actually supposed to be a pretty moot point. Going into the Fed, they said a lot of people or the treasury bonds were in a sense going to sit on their hands. So when they came together, there was actually a consensus that interest rates need to rise. That was a little bit more unexpected. So we did see a spook in the markets that hiked rates up on Wednesday. Then we saw a market correction yesterday, pretty much erasing everything bad that happened on a Wednesday. What that means for future interest rates, to be determined.
Raising interest rates has the dampening impact on rising inflation. And right now, if you're paying attention to how much money you spend at the grocery store or at the Quick Trip or at the gasoline station, you'll notice that the cost of things that we buy on the everyday is going up. Raising interest rates can force those costs back down, and that's a component of what the Fed was trying to deliver. But it didn't get received well by the market.
They did not react in any way that was expected.
So based on everything you know right here in Kansas City, what does our market look like for a mortgage lender? Good, bad, ugly?
Yeah, so the Kansas City market has always been strong. Obviously, anytime that there's a swing one way or another in the markets, we saw it in 07, 08, it starts on the coast, and really we're kind of protected in this bubble. Mm-hmm. So although we might see a hike in interest rates, we're not going to see anything that's really drastically affecting our mortgage market in a negative way. It's going to be business as usual, just with slightly higher interest rates.
Most of the interest rate changes or corrections that banks want to introduce to the real estate market happens on the coast first because the higher dollar properties are typically sold there, if that makes sense to everybody in channel with us today. As those changes roll to us in the Midwest, they typically realize that because our home values, our median home values are much, much less as a percentage, they can use less of a correction for us in the middle part of the country. Look, that's not to say that we're all cheap, it's not to say we're all poor, and it's not to say that we all live in bad neighborhoods. Do we say that as a disclaimer?
Exactly.
Do you live in a bad neighborhood?
Not that I'm aware of.
Where do you live?
So I live over by Martin City, about 127th and Holmes.
Ah, okay. So near the brewery.
Near the brewery. It was planned out that way.
So anyhow, they wanted to make sure that Adam wouldn't be affected very much with his mortgage rate. So they made big changes on the coast. And as they rolled to the middle of the country, those changes became incrementally smaller to have the same effect on our market. So we do live a bit in a bubble.
We do, absolutely. I mean, we're protected. I mean, like you said, it does kind of roll and roll. We can see that, coming and kind of predict what it's going to do to our market. But like I said, moving forward, the only thing that's really changes is just a slightly higher interest rate. But on a historical scale, very, very low. But business is going to continue as usual. Homes are going to continue to fly off the market. They might sit just a little bit longer. They might not sell with 20, 25 multiple offers in under 24 hours. But we're going to see that inventory that hits the market be sold very relatively quickly.
So let's give everybody the pro tip. What is your pro tip regarding foreclosures?
Ooh, foreclosures. So the biggest thing that you have to do is when you look at a foreclosure, you're going to want to take a look at what type of loan type you're in. If you're more of a conventional or you're more of an FHA, you got to look at what type of shape that house is in. A lot of times on foreclosures, there's deferred maintenance, repairs and things that were necessary to keep the house up to date weren't being made. Condition of the house is definitely the thing that I would take a look at when considering a foreclosure.
So let's make it super simple as we kind of summarize this thing. When you talk about the difference between a conventional loan versus an FHA loan, if you're buying a property that hasn't had all of its maintenance done and is not in top-notch condition, which loan type allows it or doesn't allow it? Which loan type is easier to use?
Yeah, so if you're looking at a house that has deferred maintenance or some issues and blemishes, you're definitely going to get away, or you're going to get off a lot easier with a conventional loan. Partly due into the fact that it's not government backed, or it's not a federally backed loan. The appraisal process is a lot less stringent on a conventional loan compared to an FHA.
Right, so keeping that in mind, there's a whole bunch of folks that are going to want to buy a potential foreclosure property, and simply it won't be available to you based on the loan type that you qualify for. Don't be upset by that. Just kind of is what it is.
Mm-hmm.
So any last minute tips we should give people for the month of June regarding money?
Just check in with your loan officer, get an updated pre-approval amount. Like I said, that buying power could have gone down a little bit with those rising interest rates, but maybe in the last 6 months you've done some good work towards your credit score. You might be able to be approved for a higher amount or get cheaper mortgage insurance. There's so many advantages that you can pick up with a higher credit score, and while you're out looking, whether it takes 3, 4, 5 months, definitely benefits to be gained if that credit score has been improved. So check in with your loan officer.
Right on. Hey, so if people want more information on how to get pre-approved, they want more information on how to apply for a loan, be a great idea for them to go ahead and direct message us down below. We also have Adam's contact information down below as well, so you can get right in touch with him and figure out how you move forward. He's always a great resource for us and the team.
Awesome, thank you.
Right on. Life is better with the team.